There's a simple truth about the global economy that most people never hear about. For more than 2 decades, financial markets around the world, from U.S. stocks to real estate, startups, and even crypto, have been powered by one thing. Not technology, not innovation, and not even investor genius, but something far more boring: cheap money. Trillions of dollars flowing through the global economy with interest rates close to zero. But here's the problem. That era of cheap money might be slowly coming to an end. And if that happens, many things we've become used to in the economy may start to change in ways most people aren't prepared for. To understand this, we need to go back to 2008, the year of the global financial crisis. Banks collapsed, housing markets crashed. Millions of people lost their jobs. At one point, the entire global financial system was on the edge of failure, so central banks stepped in. And they did something that had never been done at this scale before. They slashed interest rates to nearly zero. But that wasn't enough. So they introduced a new policy called quantitative easing, or QE. In simple terms, central banks started printing massive amounts of money to buy government bonds and financial assets. The goal was simple: flood the financial system with liquidity. When money becomes extremely cheap, something interesting happens. People start borrowing more. Companies borrow money to expand their businesses. Investors borrow money to buy stocks. Private equity firms borrow money to acquire companies. Governments borrow money to fund spending. Because when interest rates are close to zero, borrowing almost feels free. Imagine this scenario. If you could borrow $1 million at 0.5% interest, what would you do? You could buy stocks. You could buy real estate. You could invest in businesses. As long as your investment earns more than 0.5%, you make money. And that simple math is exactly why, for more than a decade, money started flowing into every type of asset around the world. When capital becomes cheap and easy to access, asset prices tend to rise. Stocks go up. Real estate goes up. Startups get billion-dollar valuations. Even companies that aren't profitable can raise hundreds of millions of dollars. During this period, a famous phrase became popular in the financial world: "Don't fight the Fed," which basically means this: when central banks are pumping money into the system, markets tend to go up. And for more than 10 years, that idea seemed almost impossible to argue with. The era after 2008 became one of the longest bull markets in history. But underneath that growth was one simple force: liquidity, lots of it. But after the pandemic in 2020, the world faced a new problem: inflation. Prices started rising everywhere: food, energy, housing. In the United States, inflation eventually climbed to around 9%, the highest level in over 4 decades. And when inflation rises, central banks have no choice but to respond. Instead of making money cheap, they have to make money more expensive. So central banks began raising interest rates fast. In the United States, interest rates jumped from nearly 0% to over 5% in a very short period of time. One of the fastest tightening cycles in modern history. When interest rates rise, the cost of money rises with it. And that affects nearly every part of the economy. Companies become more cautious about borrowing. Startups struggle to raise funding. Investors become more selective. Real estate markets slow down. And most importantly, asset prices start facing pressure. Because when interest rates are high, investors suddenly have safer options. For example, if government bonds offer 5% annual returns, investors might prefer that over riskier investments. Why take huge risks in volatile markets when safer assets are paying solid returns? This shift in behavior can change the entire flow of capital in the global economy. But here's the interesting part. Most people are still focused on the wrong stories. They talk about artificial intelligence, politics, geopolitics, crypto markets. And while those topics matter, they often distract from something much more fundamental: the cost of money. In finance, there's a very simple rule. When money is cheap, assets become expensive. When money is expensive, assets face pressure. And if you look at financial history, this pattern repeats again and again. Not because of headlines, not because of hype, but because of interest rates and liquidity. For more than 20 years, global markets have grown in an environment of extremely cheap money. A world where central banks were always ready to support the system. But if that environment truly changes, we could be entering a very different era. A world where money is more expensive, capital is harder to access, and growth becomes slower. And in that world, many investment strategies that worked in the past may no longer work the same way. Because in financial markets, the biggest forces are often not the loudest ones. They're the ones quietly shaping the system behind the scenes.